What if I told you that there is a way to protect your hard-earned money and even profit in the event of a dollar collapse? Now, in this video, I will reveal to you the safest assets that will rise in value when the dollar collapses, so you can safeguard your financial future. But first, subscribe to Success Invest and start transforming your financial mindset. Let's grow together. As investors, we all know that the dollar is not getting any stronger, and its decline can have a devastating impact on our savings and investments. Many people worry about the potential consequences of a dollar collapse, but few know how to prepare for it. If you are one of them, then this video is for you. When it comes to building wealth and safeguarding our financial future, traditional assets such as stocks and bonds may not be enough. In fact, they can even be vulnerable to the volatility of the market and can lose value in the event of a dollar collapse. This is why it's essential to diversify our investment portfolio with safer assets that can not only protect our wealth, but also increase in value over time. So, what are these safe assets? Number 1 is precious metals, such as gold and silver. These metals have traditionally been considered a safe haven during times of economic uncertainty and have a proven track record of performing well during periods of inflation and currency fluctuations. Number 2 is real estate. Direct property investment can provide a solid hedge against inflation and can also generate rental income. Number 3 is cryptocurrencies, such as Bitcoin. Although they can be volatile, they have the potential to increase in value over time, especially during periods of economic uncertainty. According to a study by the World Gold Council, gold has historically performed well during periods of economic uncertainty, and its price has increased significantly during times of high inflation. In fact, it increased by 56% in 2011 during the European sovereign debt crisis and by 22% in 2020 during the COVID-19 pandemic. A study by Forbes found that real estate investment can provide a solid hedge against inflation, and the price of real estate has historically increased over the long term. In fact, according to a study by Zillow, the median home value in the United States has increased by over 40% in the last 5 years. Jan van Eck, the CEO of Van Eck Associates, once said, "Cryptocurrencies like Bitcoin and Ethereum will have a significant impact on the financial markets and are here to stay." This is evident in the significant increase in the value of Bitcoin over the last few years. So, how can you get started with investing in these safe assets? First, you can start by diversifying your investment portfolio with precious metals such as gold and silver. You can invest in gold ETFs or buy physical gold coins. Second, you can consider investing in real estate investment trusts or REITs, which allow you to invest in real estate without directly owning physical property. Third, you can consider investing in cryptocurrencies such as Bitcoin, but be sure to do your research and understand the risks involved. As investors, we are all too aware that the dollar's value is not appreciating over time, and its steady decline can have a profoundly debilitating impact on our savings and investments, effectively eroding the purchasing power that we have worked so hard to accumulate. Many individuals worry about the potential consequences of a dollar collapse, envisioning a scenario in which their life savings become virtually worthless. And yet, few possess the knowledge and expertise to adequately prepare for such an eventuality. If you are one of them, then this discourse is intended specifically for you, as we explore the intricate dynamics of a dollar decline and examine the feasible alternatives that can help safeguard your financial well-being. Jan van Eck, the CEO of Van Eck Associates, once astutely observed that cryptocurrencies like Bitcoin and Ethereum will have a profound impact on the financial markets and are here to stay. This prophecy has been reaffirmed by the remarkable surge in the value of Bitcoin over the last few years, which has left many analysts and pundits in awe of the cryptocurrencies' seemingly unbridled potential. As the global economy continues to grapple with the complexities of monetary policy, inflation, and financial instability, an increasing number of investors are turning to alternative assets like cryptocurrencies, precious metals, and real estate to diversify their portfolios and mitigate potential losses. One of the primary reasons why cryptocurrencies like Bitcoin are gaining traction among investors is their innate ability to operate independently of traditional fiat currencies, thereby rendering them immune to the vagaries of monetary policy and the decline of the dollar. By virtue of their decentralized nature and the blockchain technology that underlies them, cryptocurrencies offer a tantalizing prospect of a secure, transparent, and highly liquid means of exchange that can efficiently facilitate transactions across the globe. Moreover, the limited supply of cryptocurrencies, coupled with their increasing demand, has the potential to drive their value upwards, thereby attracting investors who seek to capitalize on their upward momentum. However, as with any high-risk, high-reward investment, it is crucial to approach cryptocurrencies with a clear understanding of their dynamics and the potential pitfalls that they entail. Furthermore, the dollar's decline also underscores the importance of diversifying one's investment portfolio across different asset classes, such as precious metals, real estate, and international stocks. Historically, precious metals like gold and silver have proven to be a reliable hedge against inflation and a decline in the value of fiat currencies, as they preserve their value and purchasing power even in the face of economic uncertainty. Similarly, real estate and international stocks offer an attractive diversification opportunity, as they can provide a steady stream of income and potential long-term capital appreciation, regardless of the dollar's performance. By spreading investments across different asset classes, investors can minimize their exposure to the risks associated with a dollar decline, while also maximizing their potential returns in a recovering market. In addition, the dynamics of a dollar collapse and the ensuing economic upheaval also underscore the need for investors to stay informed, be vigilant, and adapt their investment strategies according to the shifting economic landscape. This entails maintaining a clear understanding of monetary policy, macroeconomic trends, and the unfolding developments in the global economy, while also being prepared to pivot when circumstances change. Investors who possess the knowledge and expertise to navigate these complexities can position themselves to benefit from emerging opportunities, even as others are grappling to come to terms with the new reality. By remaining informed and proactive, investors can help safeguard their financial well-being, even in the face of a dollar decline. Jan Van Eck, the CEO of Van Eck Associates, once said, "Cryptocurrencies like Bitcoin and Ethereum will have a significant impact on the financial markets and are here to stay." This is evident in the significant increase in the value of Bitcoin over the last few years, which demonstrates the rapidly growing acceptance and adoption of digital currencies by investors worldwide. Furthermore, the increasing recognition of cryptocurrencies by traditional financial institutions and governments underscores their legitimacy and potential for long-term sustainability. Consequently, as the use of digital currencies continues to gain momentum, it is becoming increasingly important for investors to educate themselves about the opportunities and risks associated with these emerging assets. By understanding the potential implications of a dollar decline on their investment portfolios, individuals can make more informed decisions about diversifying their assets and mitigating potential losses. The decline of the dollar can have far-reaching consequences for investors, from reduced purchasing power to decreased asset values. However, it is crucial to recognize that the decline of the dollar is not inevitable, and there are steps that investors can take to protect their assets. One approach is to diversify their investment portfolios by incorporating a mix of assets that are less correlated with the value of the dollar. This can include investing in international stocks, commodities, or currencies that are expected to retain their value even if the dollar declines. Additionally, investors may consider allocating a portion of their portfolio to alternative assets, such as cryptocurrencies, private equity, or real estate, which can provide a level of returns that is not directly tied to the performance of the dollar. Another critical aspect of preparing for a potential dollar decline is to adopt a proactive approach to managing risk. This can involve actively monitoring market trends and news, staying informed about economic developments, and making strategic adjustments to investment portfolios as needed. By staying vigilant and adaptable, investors can identify potential risks and opportunities earlier, making it easier to respond to changing market conditions. For instance, investors may choose to shift their investments from assets that are heavily exposed to the dollar, such as domestic stocks or bonds, to assets that are more resilient to currency fluctuations. By taking a proactive stance on risk management, investors can help to safeguard their financial well-being and protect their investment portfolios from potential declines. In recent years, there has been increasing recognition of the importance of hedging strategies in mitigating the risks associated with currency fluctuations. As the value of the dollar continues to decline, investors are becoming increasingly interested in identifying alternative assets that can provide a level of returns that is not directly tied to the performance of the dollar. One such strategy is to invest in assets that have historically performed well during periods of economic uncertainty, such as gold or other precious metals. These assets can provide a safe haven for investors seeking to preserve their purchasing power and minimize potential losses. Furthermore, investors can also consider diversifying their portfolios by incorporating assets that are not directly correlated with the dollar, such as cryptocurrencies or other digital assets, which can offer potential returns without direct exposure to the dollar. Ultimately, preparing for a potential dollar decline requires a comprehensive and multifaceted approach that involves not only diversifying one's investment portfolio, but also adopting proactive risk management strategies. By educating themselves about the potential implications of a dollar decline on their investment portfolios, individuals can make more informed decisions about allocating their assets and mitigating potential losses. Furthermore, by staying adaptable and responsive to changing market conditions, investors can help to safeguard their financial well-being and navigate even the most challenging economic environments. When it comes to building wealth and safeguarding our financial future, traditional assets such as stocks and bonds may not be enough. In fact, they can even be vulnerable to the volatility of the market and can lose value in the event of a dollar collapse. This is why it's essential to diversify our investment portfolio with safer assets that can not only protect our wealth, but also increase in value over time. For instance, precious metals like gold and silver have historically been a hedge against inflation and dollar devaluation, making them an attractive addition to a diversified portfolio. Furthermore, investing in emerging markets or countries with strong economies and stable currencies can also be a viable strategy to mitigate the risks associated with a declining dollar. Another option is to invest in assets that are backed by real-world value, such as agricultural land or forestry, which can provide a tangible and reliable source of returns. The concept of diversification is not just about spreading investments across different asset classes, but also about investing in assets that have a unique value proposition. For example, cryptocurrencies like Bitcoin and Ethereum have gained traction in recent years due to their limited supply, decentralized nature, and increasing adoption. While they can be volatile, they offer a distinct alternative to traditional fiat currencies and can potentially thrive in a dollar-declining environment. Similarly, private equity and venture capital investments can provide exposure to innovative and growth-oriented companies that are less correlated with the broader market. Real estate investment trusts, REITs, and real estate crowdfunding platforms can also provide a way to invest in income-generating real estate assets, which tend to perform well in times of economic uncertainty. Another key aspect of navigating a declining dollar is to be mindful of the impact of inflation on our purchasing power. As the dollar loses value, prices for goods and services are likely to rise, eroding the value of our savings and investments. To mitigate this effect, investors can focus on assets that historically perform well in inflationary environments, such as real assets, commodities, or Treasury inflation-protected securities. Tips. Additionally, consider investing in companies that have a strong track record of generating profits and have pricing power, allowing them to pass on increased costs to their customers. This could include investing in indices or ETFs that track the performance of companies with high dividend yields, which can provide a regular income stream that keeps pace with inflation. By taking a proactive and informed approach to managing our investments, we can reduce our reliance on the dollar and build a more resilient financial foundation. The decline of the dollar can also have significant implications for our retirement and long-term financial goals. As traditional assets like stocks and bonds may not be able to generate the same level of returns in a declining dollar environment, it's essential to think creatively about how we can generate income and grow our wealth in retirement. One strategy is to focus on building a portfolio of dividend-paying stocks, which can provide a relatively stable source of income that can keep pace with inflation. Alternatively, consider investing in real estate or alternative assets that can generate rental income or royalties, providing a regular stream of passive income. Furthermore, investors may want to explore the potential benefits of tax-advantaged accounts, such as Roth IRAs or 401k plans, to optimize their tax strategy and maximize their retirement savings. By taking a proactive and informed approach to managing our retirement savings, we can build a more sustainable and resilient financial future, even in the face of a declining dollar. A study by Forbes found that real estate investment can provide a solid hedge against inflation, and the price of real estate has historically increased over the long term. In fact, according to a study by Zillow, The median home value in the United States has increased by over 40% in the last 5 years. Moreover, this trend is not limited to the residential sector. Commercial real estate has also seen a significant surge in value in recent years. Investors who have strategically positioned themselves in the real estate market have been able to reap substantial returns, thereby safeguarding their wealth against the erosive effects of inflation. It's little wonder, then, that real estate remains an attractive option for individuals seeking to diversify their investment portfolios. The effectiveness of precious metals as a hedge against economic uncertainty is another well-documented phenomenon. Traditionally, assets such as gold and silver have been viewed as a safe haven during times of inflation and currency fluctuations. Their intrinsic value, coupled with their perceived worth, has consistently driven demand for these metals, thereby translating into higher returns for investors. Moreover, unlike other assets, precious metals can be easily liquidated, providing a high degree of fungibility. For instance, in times of economic downturn, investors can quickly sell their gold or silver holdings to access capital, thus providing an additional layer of protection against unforeseen events. As a result, assets such as gold and silver have become staples of diversified investment portfolios. In addition to precious metals and real estate, an increasing number of investors are turning to cryptocurrencies as a means of hedging against inflation. Assets such as Bitcoin have garnered significant attention in recent years, thanks in part to their potential for generating high returns during periods of economic uncertainty. While the volatility associated with these assets can be off-putting to some, an increasing number of savvy investors are taking advantage of their growth potential. Furthermore, cryptocurrencies offer an additional layer of security in the form of their decentralized nature, thereby reducing the risk of central bank manipulation. For instance, the blockchain technology that underlies cryptocurrencies, such as Bitcoin, ensures that transactions are both transparent and secure. As the world becomes increasingly digital, it's little wonder that an increasing number of investors are turning to cryptocurrencies as a means of diversifying their portfolios. In the context of real estate investment, there are several key factors to consider. First and foremost, location remains a critical determinant of an investment's potential for growth. Areas with high demand, limited supply, and favorable economic indicators are generally more likely to see significant increases in property value. For instance, regions with strong job markets and favorable demographics often see increased demand for housing, which in turn drives up prices. As such, investors would be well advised to conduct extensive research into potential markets prior to making an investment decision. Another factor to consider is the property type itself. For example, residential properties may offer more growth potential in certain markets than commercial properties. An in-depth understanding of local real estate trends is essential for maximizing returns on investment. From an investment perspective, the choice between precious metals, real estate, and cryptocurrencies will depend largely on an individual's risk tolerance and investment objectives. For instance, investors with a low risk threshold may be better suited to more traditional assets such as gold and silver. Conversely, investors willing to accept higher levels of risk may find that real estate or cryptocurrencies offer greater growth potential. In any case, it's essential that investors conduct thorough research and consider multiple viewpoints prior to making an investment decision. This may involve consulting with financial advisors or conducting extensive market research. By doing so, individuals can ensure that their investment portfolios are positioned to thrive during periods of economic uncertainty. In conclusion, the potential collapse of the dollar is a very real threat to our financial security, but by investing in safer assets such as precious metals, real estate, and cryptocurrencies, we can protect our wealth and even profit in the event of a dollar collapse. Remember, it's essential to diversify your investment portfolio to minimize risk and maximize returns. Check out other videos on this channel for more tips on how to safeguard your financial future. And if you haven't already, be sure to subscribe to our channel for more informative content.